this learning objective, we explain how to assess the performance of an international investment. In previous videos, we've discussed the idea of how we can decompose overall portfolio excess returns into different components. We can extend this idea of performance attribution to looking at assessing the performance of an internationally diversified portfolio. Within the context of international performance attribution, we're considering four key factors. Those four key factors are the impact on our overall excess returns of currency selection, country selection, stock selection, and last of all, the asset allocation decision. So let's have a look at a bit of an example that demonstrates how we can look at performance attribution in an international portfolio. Let's imagine that we are managing a portfolio that is exposed to three different continents: Europe, Australia, and Asia. And what we can see here is we're going to come up with some benchmark portfolio, and that benchmark is going to have weightings across each of the three regions or countries. We're going to have an index return across each of those regions or countries. And we're going to have our own weighting across each country and our own return within each of those countries. Furthermore, we've also got the degree of currency appreciation or depreciation in each of those countries. So we're going to assume that we're investing here from the perspective of a US investor. So these are all going to be foreign currencies. So we're going to have some degree of appreciation or depreciation in each. So what do we do? Well, we can look first of all at whether we've overperformed or underperformed by looking at the benchmark return, multiplying the benchmark weights by the return on equity indices, and comparing that to our own portfolio performance, whereby we look at our own weights across each asset class compared with the returns that we were generated in each of those countries. When we do this calculation, we can actually find that we underperformed by a total of 10 basis points. We can see that down here. We can see that the benchmark generated a return of 32.5%, just looking at the weightings in each asset class, the weighting in each country, the return in each country, also the exchange rate return in each country, and we get that 32.5. Our portfolio, we've got the weighting in each country, the return within the country, and the appreciation or depreciation on the exchange rates there. So we've lost 10 basis points relative to the benchmark. And what we really want to know is, well, why was that the case? How can we explain this performance? The first thing we can look at is currency selection. So we have relatively under or overweighted particular countries, and we want to know, did that work in our favour or did that work against us? Now, what we can see just from some preliminary analysis up here is that compared with the benchmark, we've overweighted Europe and underweighted Asia. Now, interestingly, Asia was the country that had the biggest currency appreciation. So the fact that we underweighted the country that had the biggest currency appreciation obviously means that we didn't do well in terms of currency selection. Let's show that. So the benchmark had 30% in Europe, where the currency appreciated by 10%. The benchmark also had 10% in Australia, where the currency depreciated by 10%. And the benchmark had 60% in Asia, where the currency appreciated by 30%. So the gain in the portfolio due to currency risk, if you like, was a 20% appreciation, because on average, these foreign currencies appreciated against the US dollar. In our own portfolio, we had 35% in Europe for a 10% appreciation. We had 10% in Australia, where there was a 10% depreciation in the currency. And we had 55% in Asia, where there was a 30% appreciation. So in our portfolio, foreign exchange risk had a positive impact of 19%, but compared to the benchmark, we underperformed here. So our currency selection resulted in a loss of 1% relative to our benchmark. What about country selection? So here we're looking at the relative weightings and looking at whether we over or underweighted particular countries in a good manner depending on their performance. Now, we can look at this informally once again, remembering from before, we said that we underweighted Asia and overweighted Europe. Once again, that doesn't look to have been a great call because we underweighted the country that had the biggest returns on their market index, and we overweighted the country that did okay, but just not as well as Asia. So we can demonstrate it again by showing, well, what was the contribution of country selection to the benchmark? We can see that the benchmark had 30% in Europe, which generated a return of 10%, had 10% in Australia, which generated a return of 5%, 60% in Europe, which generated a return of 15%. So the return due to currency selection in the benchmark was 12.5%. I do the same using our weightings and the index returns, and we see that our country selection resulted in a return of 12.25%. But once again, we've actually underperformed the benchmark due to country selection. The last question now is stock selection. So given our relative weightings across each country, how did we perform in terms of stock selection by comparing our return in each country to the index return in each country? Now, at first glance, it looks like we did pretty well because we outperformed in Asia and Australia and slightly underperformed in Europe. Once again, let's prove this. So we had 35% invested in Europe, and in Europe, we underperformed by 2%. We did 2% worse than the market, so it's minus 2% there. We had 10% in Australia, and we outperformed by 2% in Australia. You can see that here. And we had 55% of our portfolio in Asia, and we outperformed by 3% in Asia. So the total contribution of our excess returns due to stock selection is 1.15%. That is, we outperformed the benchmark by 1.15% due to stock selection. We add all these values together, so underperformance of 1% due to currency selection, underperformance of 25 basis points due to country selection, and overperformance of 1.15% due to stock selection. Add those together and we get our overall underperformance against the benchmark of 10 basis points or 0.1%. So that demonstrates how we can look at our overall excess returns or overall returns compared with some benchmark and then break it down into its relative contributors. What is the component of that overall underperformance that might be explained by a range of factors including currency, country and stock selection.